generally, loss mitigation, specific mortgages, including home equity loans and home equity lines of credit, reverse mortgages, and contracts for deeds, also known as executory contracts. And then we'll have a brief Q&A at the end. So here at Lone Star Legal Aid serves 76 counties across 1/3 of Texas and 4 counties in Arkansas. With 14 offices, we cover a large area, including rural communities. At about 1.9 million people in our service area qualify for legal aid based on their income. Last year, we handled over 23,000 legal cases impacting over 60,000 people, including children, veterans, and peoples with disability. Some fast facts about Lone Star Legal Aid is, again, we service 76 counties with 14 offices, including 13 branch offices in Beaumont, Belton, Bryan, Clute, Conroe, Galveston, Longview, Nacogdoches, Paris, Richmond, Texarkana, Tyler, and Waco. And in a few slides, I'll have the addresses and phone numbers of where those offices are, and feel free to write them down in case the area you live is the specific area for service. Okay. So over the years, two legal aid firms have expanded their reach with increasing numbers of counties included in their respective service areas. In the 1960s, the Houston Legal Foundation offered criminal defense for a period in response to the Supreme Court decision in Gideon v. Wainwright. And the Houston Legal Foundation eventually became known as the Gulf Coast Legal Foundation. In the 1980s, East Texas Legal Services created the East Texas Fair Housing Center to investigate, address, and monitor corrective actions related to violations of the Fair Housing Act. In 2002, East Texas Legal Services, which was a largely rural legal aid program, and the primarily urban Gulf Coast Legal Foundation, along with a portion of Legal Aid of Central Texas, combined to become Lone Star Legal Aid as you know it today. Lone Star Legal Aid is the third largest legal aid organization of its type in the United States. Here at Lone Star Legal Aid, we have a proud tradition of successful client-centered work, and historically, the firm has won victories that affect not only the client who initially presented a particular issue, but groups of low-income people on community, state, and national levels. The firm's actions have resulted in systemic policy and procedural changes like public housing desegregation and healthcare access for children. So who do we help here at Lone Star Legal Aid? We primarily help low-income individuals and families who face legal challenges in civil matters. These could be housing issues, family problems, or consumer issues. Many of our clients live in rural areas or face language barriers. For example, over 1.5 million people in our region speak a language other than English. Access to legal help is critical, and there's only one legal aid attorney for every 17,000 people who qualify. Our mission here at Lone Star Legal Aid is to protect and advance the civil legal rights of low-income Texans. We provide legal advocacy, representation, and education to ensure everyone has equal access to justice. To be eligible for our services, you must live in one of the 76 counties we serve and meet our income guidelines. We only handle civil cases, meaning we don't do criminal defense. If you qualify for our services, we can help with a wide variety of civil legal issues. Some area of laws that we cover. We handle many different types of civil laws, such as consumer protection, family law, housing, public benefits, foreclosure prevention, and more. This includes help with employment, healthcare, juvenile issues, and neighborhood disputes. Our goal is to address the everyday legal challenges that low-income Texans face every day. We also do have some special projects. So in addition to general civil legal help, we have several specialized projects. These include disaster relief, helping survivors of sexual assault, We also provide military and veterans assistance, eviction defense, and environmental justice, amongst the others that are listed on your screen. Our goal is to meet the diverse needs of our communities. And I'm sure you're asking, well, how do I get help with my civil legal need? You can get help by applying 24 hours a day, 7 days a week by visiting www.lonestarlegal.org. If you do not have access to the internet, you can also give us a call at 1-800-733-8394 Monday through Friday during regular business hours or 8 a.m. to 5 p.m. So as I discussed previously, these are our branch offices, and I'll pause just for a second or two in case you need to write down the address and phone numbers. So here we have our Beaumont offices: Belton, Bryan, Clute, Conroe, Galveston, Houston, and Longview. Then we have offices in Nacogdoches, Paris, Texarkana, Tyler, Richmond, and Waco. You can also follow us on social media, where we send out a wide variety of legal information for you. You can follow us on Instagram, and our handle is @LoneStarLegalAid. Our Facebook is @LoneStarLegalAid. And on YouTube, you can find us at LStar Legal. So I'm going to jump over into disaster assistance right now and give you just a brief information about some helpful information relating to disasters. If you visit our website at www.lonestarlegal.org, at the top of our screen, you will see a prompt that says, "Were you affected by recent storms?" And then you can click on that banner and it'll take you to some information regarding our recent storms, including Hurricane Beryl. Then, let's see, well, in regards to FEMA, I know everybody has questions about FEMA assistance and whatnot. So there is federal assistance now available to individuals impacted by Hurricane Beryl. This aid can help with temporary housing, home repairs, low-cost loans for uninsured property losses, and other programs designed to support recovery efforts. If you have sustained losses, you can apply for assistance through the following means. You can go online to www.disasterassistance.gov. You can call FEMA at 1-800-621-FEMA or 3362. Again, that number is 1-800-621-3362. You can also download the FEMA app through your Google Play Store or your Apple Store. Relay service users provide FEMA with the number for your relay services. So the application deadline to apply for disaster assistance from FEMA is Thursday, October 10th, 2024. So make sure if you haven't applied yet to apply by October 10th, which is a Thursday. You can also apply with the Small Business Association disaster loan application. And homeowners, renters, and businesses of all sizes in areas designated as disaster zones may be eligible for Small Business Association disaster loans. Visit lending.sba.gov to get started. And I did just recently learn last week that even if you are approved for an SBA loan, you don't have to accept it and you can still go through FEMA. So we do have some disaster recovery flyers on our website. You would just have to go to www.lonestarlegal.org/barrel/. Some flyers that we do provide are how to avoid home repair fraud, renters' rights after a disaster, insurance steps, replacing lost documents, and then a bunch of other small flyers that include State of Texas Emergency Assistant Registry, checking your home for structural elements, checking your home's utility systems and household items, recovering emotionally after a disaster. I know that can affect some of us mentally. Financial recovery after a disaster, maybe your business was closed and so you were out of work. The Small Business Administration again. And then what can FEMA do for you? I know sometimes we have a lot of questions about what is FEMA. What is FEMA and what does it do after a disaster? Again, we talk about disaster. There's a flyer about disaster unemployment, and it gives you information about how to apply and what you need to apply. Then our disaster SNAP benefits, as well as immigrant eligibility for disaster assistance. And then I will hand it over to Amir.
Thank you so much, Sam, and thank you for that great introduction on all the things that Lone Star Legal Aid does, and importantly highlighting the fact that disaster assistance is still available for those of y'all in Southeast Texas who are still recovering from Hurricane Beryl. I know, those of y'all who are impacted in the greater Houston area, yeah, the lights are back on, but you might still be struggling. The deadline to apply for assistance from FEMA, whether it's to recover for food or the cost of a generator or damage to your car, property, what have you, is 2 weeks from today. That's October the 10th. So if you're watching this live, you got 2 weeks. If you're watching the recording, take whatever day you're at and just make sure it's not October the 11th, because the deadline is the 10th. Now, for my portion of the presentation, you're going to hear back from Sam towards the end of our talk today, but we're going to be talking about mortgage foreclosures in Texas generally. And there's a wide variety of types of mortgages. We'll get into each and every one of those. We're going to be talking about mortgages that are governed by Texas Property Code, Chapter 51, the Texas Constitution, Article 16, or for those of you who like Roman numerals, XVI, deed of trust and promissory notes for mortgage. So those are the contracts, the two sets of documents that when you take out a mortgage, you're going to be signing and reviewing. So let's talk about the different types of mortgages. So the most common type of mortgage that people know and understand is the type that you use to buy your house. This is referred to as a forward mortgage in technical jargon, which is different than a reverse mortgage, which we will explain in a few slides. But we'll just refer to this as a mortgage or a regular mortgage or a purchase money mortgage. We're talking about the exact same thing, no matter which term I'm using. There's also reverse mortgages, which are the reverse of a regular mortgage. So with a regular mortgage, you make a monthly payment, and you're responsible for doing that for a period of time, generally 15, 20, 30 years. With a reverse mortgage, you don't make any monthly payments. Now, there are some other responsibilities and obligations, but we'll get into those when we get into our deep dive on reverse mortgages later in the presentation. We'll also be talking about deferred balances and partial liens. These are often referred to or known as second liens. These happen when people are trying to get caught up on maybe a home equity loan or a forward mortgage or a purchase money mortgage. We're going to do a deeper dive into what those are. Just second lien, we're talking about those sorts of things. There's also home equity loans and home equity lines of credits, or HELOCs. These are where you take out a second mortgage on your house, or if you've paid off your first mortgage, you take out the home equity loan to tap in to maybe an increase in value on your home to pay off other debts. We're going to discuss that in more detail as well. And then we're also going to talk about seller financing, often referred to as, legally referred to in Texas as an executory contract, but known as land sale contracts, lease to own, contract for deed, and a variety of other names. Basically, you get a piece of paper that says you can buy the house, but you don't have a deed until you pay it off. That is what an executory contract is. Samantha and I will be talking about those in more detail towards the end of the presentation. So what is mortgage foreclosure? Well, mortgages, you have to understand how a mortgage company gets the legal right to foreclose. So when people take out a mortgage, when you buy a house, most people don't have the cash, pay cash for a house. The average price of a house in the greater Houston area is around $360,000. That's 360,000. People don't have that kind of cash just lying around. I know I personally do not. So people go to a bank and they ask for a mortgage. Now, the bank will have you, they'll do their credit check and what have you, but they'll have you sign two documents. One is called a promissory note. A promissory note is, I promise to repay this money over a period of time at a certain interest rate. Generally, you might see a 30-year mortgage, and the interest rates right now are around 6%. They're going down, but 6.1, I believe, is what I saw this morning, is the average across the United States for interest rates. And most people are paying a mortgage off over 30 years. The 30-year mortgage is the very, very common, most common type of mortgage since basically World War II. That's the first document. The second document is what's called a deed of trust. And this is where the bank in writing in a contract says, we trust you to pay, but we want to use your house as collateral. So if you don't pay, we have the legal right to take the house and sell it to collect our money. That whole process that I just described, that legal right, is called a lien. So the first bullet point on this slide is mortgages place a lien on your home. So if you financed the purchase of your house, that means you went to a bank and asked them to lend you money. You borrowed money to purchase the house. There's more than likely a lien on your house. As I mentioned, the lien is an obligation to pay debt that can be enforced by selling. That is what foreclosure means, forcing you to pay back your debt by taking your house. Now, this last bullet point indicates that a home can sell for less than the market value. So if your house is worth $360,000 and you owe $200,000 on the mortgage company, when they sell your house, is going to start the bidding at $200,001. It's just like The Price is Right. And anybody who's bidding on the house is going to want to keep the price as low as possible. That can result in substantial loss of equity and is something to think about if you or friends or family or anyone you know might be facing foreclosure. Their home is no longer affordable due to a variety of reasons we'll talk about in more detail later. Selling might be the best way to really capture the equity or the increase in value in your home. So let's talk about the two main players in the mortgage landscape. So we're going to spend some time on the first, which is the owner, investor, or insurer. And then we're going to jump to the second, which is the term servicer. So an owner, an investor, and insurer is the entity or company that finances or backs the loan. They basically came up with the money to create the mortgage. They set the rules that a mortgage servicer has to follow when interacting with you, the borrower. So basically, they're setting the rules to say, this is when payments have to be made. This is what our contract says. This is the types of relief options we'll make available to borrowers who might be struggling. A vast majority of mortgages in the United States are supported by a federally backed company. So federally, like part of the United States government. Fannie Mae, Freddie Mac, Ginnie Mae, those three entities control about 55% of the mortgage market in the United States. You also have FHA mortgages, which is part of the U.S. Department of Housing and Urban Development, another part of the United States government. You have VA loans, which are issued to veterans. And then you have loans made by the United States Department of Agriculture, or USDA, through their Rural Housing Service. Collectively, those four different types of federally backed mortgages make up about 65% of the overall mortgage market. So roughly 2/3 have the federal government as the entity that came up with the money to issue to guarantee the mortgage. Now, the remaining 1/3 is often a private entity or private company like a bank or a trust. And why is it important to know? Why are we spending so much time on this slide talking about who owns your loan, who created the loan? It's because they set those rules, and this is who you're going to be interacting with if you ever have a problem with how your mortgage is being run, or if you ever need some relief to maybe lower your payment or give you a pause. Now, as I just mentioned, here's a pie graph illustration of the percentage. So if you look at the green part of the pie chart, GSE stands for Government Sponsored Enterprise. That's another acronym for this is a private company that's backed by the federal government. I won't take you through the details on why they're backed by the federal government, but you can see 47% of mortgages are owned by Fannie Mae and Freddie Mac. Now, 18% of the remaining mortgages are owned by the FHA and VA. And you could throw USDA in there. I just don't think it fit on the pie chart. Between the two of them, you get to 65%. So banks make another 25%. So these are private banks. These are what might be referred to as a conventional loan. PLS, private label security. This is a loan that's traded on the public markets, and all others. So these would be the types of alternative mortgages that we will talk about, generally referred to as those contract for deeds, or single family real estate investors. The second player in the mortgage landscape is the loan servicer. So the loan servicer is an agent for the owner. So if Fannie Mae or Freddie Mac owns your loan, Fannie Mae and Freddie Mac are not sending you the monthly statements. Fannie Mae and Freddie Mac are not collecting payments. They're going to hire Bank of America or Chase or Select Loan Services or PHH or NewRez. Those are names of very common servicers. That's a middleman. If you have a problem and you see a phone number on a statement, first off, that statement's going to be from PHH or any of those companies I just listed. When you call that phone number, you're going to speak to a representative for PHH, not the owner. The servicer exists solely to act as the agent, to act on behalf of the owner, to follow its rules and to interact with the borrowers on behalf of the owner. This is who you're going to be interacting with, the servicer, if there are ever any issues with the loan. So if you need to work out something to get caught up on payments, or if there's a dispute, maybe the primary borrower has passed away and the servicer won't talk to you, how do you work around that? You're going to be dealing with the loan servicer. Now, a few things to know. Loans, mortgages, do change investors from time to time. So the owner of your loan might be Fannie Mae, and then it gets sold into the private market and becomes a private, publicly traded private label security. Or if it's originated by FHA, it's generally going to stay with FHA, the United States government. If it's originated by the VA, it's going to stay with them as well. But FHA loans, VA loans, they can change servicers. So you have two different moving parts. The owner could change, except for a few exceptions that I just mentioned, and the servicer often does change. And the issue here is, or really the point is, you as the borrower, you as the homeowner, have no say in how that happens. You don't get to choose who the servicer is going to be. And I will tell you, just from my 12-ish years of experience helping homeowners, just like those of y'all watching, maybe watching on the recording or watching live, some servicers are better than others. So it's important to understand the information we're going to talk about today, to arm yourself, to educate yourself, and protect your rights. Now, there are rare situations where the owner of your loan is the same company as the servicer of your loan. I'll use myself as an example. My mortgage that I used to buy my house 3 years ago is with Wells Fargo. I contacted Wells Fargo. I did their little application, worked with the loan officer from Wells Fargo. Wells Fargo came up with the money to help me buy my house. I get my monthly statements. I place phone calls to customer service to Wells Fargo. I knew that going in. That was something that was attractive to me, because the first house that I bought 7 years ago, the servicer, I took it out with a local bank here in Houston. The servicer changed within a week of me getting the mortgage, and then it changed 3 times in the remaining 4 years. So, after I sold that house, I didn't want to deal with it again. And Wells Fargo at the time was guaranteeing that we will make your mortgage or originate and also service your mortgage, which I found very attractive. I want to set up auto pay, and I don't want to have to do it again. I want to know who I have to call, and I don't want to have to do it again. I use that as an example. I don't know if Wells Fargo still does that, but that is a rare situation in my experience where the owner of your loan is also the servicer of your loan. Now, one bullet point here is if you have a non-traditional mortgage, so again, a seller financed mortgage, everything that I just described more than likely is not going to happen to you. Most seller financed mortgages is like a one-off mom and pop. They had a second house. They didn't want to sell it, or they didn't want to rent it out, so they decided to sell it. They sell it to somebody, they're not going to be represented by Bank of America as a servicer. Whoever sold it to you or financed it to you is the person that you're going to be making your monthly payments to as well. We'll talk about these in more detail as we go along. Now, a mortgage company can't just take your house. You have to be in default before a lender can foreclose. Now, a default is a fancy term for you allegedly broke some promise you made in the contract. The most common default is if you fall behind on your mortgage payments. Other types of defaults are maybe you had insurance on the house, which your mortgage contract, I guarantee you, requires you to do, and you forgot to renew it. That's technically a default. Now, there's ways around it, but just to keep things simple, not renewing your insurance is a default. Or your mortgage contract required you to pay your property taxes, which, again, I can guarantee you in Texas, it does require you to pay your property taxes. And your deadline to pay taxes in Texas is January 31st. But you missed the deadline. Things come up. It's the new year. Forgot. That's a default as well. There's other types of defaults and ways of working around them, which we will discuss. But as the middle part of this slide indicates, when a default's declared, this is when the different types of defaults that are declared, this is when a mortgage company can start the process to try and foreclose on your house. Now, in order to stop the default, to keep your house, you can try to get back in good standing through what's called loss mitigation. And I don't want you to get lost in those words. It means we don't want you to lose your house. There's a process, there's a set of laws that dictates what mortgage companies have to do here. And we'll discuss these in more detail. So some reasons that people might default on their mortgage. If you had a variable rate mortgage, which are rare these days, but were very popular in the early 2000s till about 2008, 2009, your monthly payment might have been $1,600 a month when interest rates were around 2%. Now that they're around 6%, your monthly payment's like $2,200 a month. And I'm just making those numbers up, and you might not be able to afford it. That can be a very common way that you can fall into default. Or, as I like to refer to, one of the 4 Ds happen to you: death, disability, divorce, or disaster. So in any one of those situations, your income, your family's income, could be cut. In a death, you might have 2 spouses where one passes away. Now half the family's income, or maybe all of the family's income, is gone. That's definitely going to impact people and make it hard, if not impossible, to afford your mortgage payment. Disaster, you might think in the greater Houston area, with Hurricane Beryl or Hurricane Harvey 7 years ago, or what have you, that impacted people's ability to work. And if you miss a week of work or a couple of days of work, it might impact your ability to meet those obligations, living paycheck to paycheck. Divorce, similar to death, when a couple splits up, you're looking at maybe losing all, if not, or half, if not all of the income, which can definitely impact your ability to pay your mortgage payments. And then disability, this is where you might be able-bodied and working, and then disease or a car accident or whatever calamity strikes, and you're no longer able to work. Now your income's been reduced below what you were previously earning, and that's impacting your ability to pay. Oftentimes, I can't give you an exact percentage, but a vast majority of the clients that Samantha, myself, and the rest of my team at Lone Star Legal Aid serve, everything was fine, and then one of the 4 Ds struck. So if you're coming to this presentation or sharing it with a friend or family member who might be struggling, more than likely, through no fault of their own, one of these things happened to make it to where they fell behind on their mortgage. And I want you to keep that perspective in mind. You also might have a situation where maybe you still have your income, but you have new expenses. There's a new baby, or you've adopted someone, or you're taking care of a family member, or someone's having a serious illness like cancer and having to go through a very expensive medical treatment. These sorts of things happen. Life happens. You can't control that. We can do the best we can to plan for the future, but no one on this call and no one that I know has a crystal ball and can predict the future. So the key is to understanding your rights and then being able to bounce back and be resilient. Oftentimes, as the last bullet point puts here, we're going to talk about this in more detail, with reverse mortgages, because you don't have a monthly payment, people might not realize that you actually have to pay your property taxes and your homeowner's insurance, and fail to do that because they don't have that monthly payment, those monthly statements reminding them to do so. Now, how does foreclosure, actually the process of selling your house to collect on a debt, work? Let me get to that in just a second. So Texas is referred to as a non-judicial foreclosure state. That's a fancy way of saying if someone wants to foreclose on you, if your bank wants to foreclose on you, or the person who holds the lien wants to force the sale of your house, they don't have to take you to court. They don't have to sue you. Now, that's 90% of the time that's accurate. We're going to talk about what judicial or court-ordered foreclosures look like in a slide or two. If someone, or if a bank or someone with a lien goes through the process of the non-judicial foreclosure process, there's a few things to keep in mind. First, if you're dealing with a large bank, even a small, medium bank, you're dealing with a company that makes more than 4 loans a year. In order for them to foreclose on you, you have to be 120 days behind on your payments. That's generally 4 months. I'm sorry, 3 months. Right, 3 months. I'm sorry. There's a reason I'm a lawyer, not an accountant, but I do have calculators. So once you're 120 days delinquent, then the mortgage company can send out the first statement that indicates that they're going to start the foreclosure process. In Texas, that's what's referred to as a notice of default. This notice of default has to be sent to you by certified mail. The mortgage company does not have to prove that you actually got it. They just have to send it to the correct address. They have to send it by certified mail, and they have to give you at least 20 days notice. Like, hey, you're behind 3-4 months on your payments. This is the number. You have 20 days. Most often the time it's 30 or 45 days, depending on the mortgage contract, to come up with that money. And then most notices of default will then say, if you don't, this is what will happen. And the what will happen will say is the second to the last bullet point. The mortgage servicer is going to accelerate the balance of the mortgage. That's a fancy way of saying you owe everything right now. And after that process happens, after a notice of default comes through, and in that notice of default, the lender tells you that they're going to accelerate. If you miss the deadlines, if you're not able to get current, the next thing you'll receive is what's called a notice of foreclosure sale. This also has to be sent by certified mail. And this notice of foreclosure sale, or it might be referred to as a notice of trustees sale, it will have to have been put in the mail 22 days in advance of the first Tuesday of the month where your house is going to be sold. So let me back up a little bit. The first Tuesday in October is next week. It's October the 1st. If someone's home was going to be lawfully or legally foreclosed upon and sold, the notice of that would have had to have been sent 2 weeks ago, or it had to have been put in the mail on September the 10th. If it was put in on September the 11th, you missed the deadline. If it's put on September the 9th, you're fine. But if it wasn't put in the mail on September, if it was put in the mail on September the 10th, even if the borrower gets it a couple of days later, it passes the legal requirements for Texas. So just to quickly back up, if a lender or lien holder is going to take you through the non-judicial foreclosure process, they do not have to take you to court. That's number one. The first thing they need to do is send you a certified letter saying you're in default and wait 20-ish days. It might be longer, but the bare minimum is 20. And then if you haven't fixed the default, then they have to mail you a second letter saying, we've now scheduled your house to be sold on the first Tuesday of the month. Here's the advance notice. We put it in the mail 22 days in advance. You could see how in a very quick process, you could fall behind on your mortgage. You have to be 120 days behind. But once the process starts, it can be done in 3 months. The non-judicial process can move very, very quickly. And so anyone who's in this situation should not stick their head in the sand or pray for things to change. I'm not discounting the power of prayer, but I do indicate you gotta empower yourself with this information and reach out to people who can help. Talk to your bank. If the bank won't work with you, I encourage you to reach out to Lone Star Legal Aid or a private lawyer for help navigating this process. Now we just went through the non-judicial process. Now I'm going to take you briefly through the judicial process. And again, to distinguish between the two, non-judicial means there's no judge involved and no one's going to court. Judicial process means in order for the bank, the lien holder, to have the authority or the legal right to sell your house, they got to get the blessing from a judge. So if you remember nothing else that I talk about here, Just understand that it's going to take a little bit longer than that 3 months process that I just went through. Judicial foreclosure can generally only occur in 3 types of foreclosures. We're going to talk in detail about 2 of them. We'll have a whole nother presentation about the third, about homeowners association foreclosures, but I'm just going to touch on it very briefly. Judicial foreclosures are required for home equity loans or home equity lines of credits, reverse mortgages, and then also homeowners association foreclosures. None of those 3 types of entities or companies can foreclose on you without getting a judge to agree that this is lawful and can be done. Now, sometimes with regular mortgages or purchase money mortgages, when someone passes away and then the mortgage payments aren't paid and no one has probated that person's estate, so the mortgage company literally doesn't know who inherited the house, a mortgage company might file a lawsuit then. It's rare, it's not required, it's best practice, but some mortgage companies do it, some do not. If that happens, you might have heirs who inherited, who are guessed to have inherited. They might be the children of the mom who was the borrower. They all get sued. That doesn't mean you owe the money. That just means the mortgage company is trying to cut off your property rights or your rights to inherit this property because ain't nobody paid on it, and they have a lien that allows them to foreclose on it. Now, there are 2 types of lawsuits that can be used to foreclose on someone. A quote unquote regular judicial lawsuit can take somewhere between 6 months and 2 years to get resolved. Most often, mortgage companies with home equity loans or reverse mortgages will use an expedited lawsuit. These generally take about 6 months to resolve. And when I say resolve, that means they filed it and then they have a court order that allows them to then schedule the foreclosure sale. Now, the process here, as dictated on the last bullet point, is the end process is the exact same as a non-judicial foreclosure, meaning once the judge has signed off and said, you bank or you homeowners association have the legal right to foreclose, the bank or the homeowners association then has to mail out notice by certified mail 22 days in advance, saying, we scheduled your house to be sold on the first Tuesday of the month. This is the day, this is the time, this is the location. Now, you might see on the slides it says 21 days. The law says 21 days. And I don't want you to think that I'm misquoting the law. The law says the notice has to be put in the mail 21 days in advance. The law also says you don't get to count the day that it was put in. So I always add 1 more day because legally that's what happens. 22 days notice is what's required, or 22 days for the letter to be in the mail. Now, jumping back to non-judicial foreclosure, as we mentioned before, and I jump ahead on the slides all the time, I'm sorry. We've talked about this, which is a non-judicial foreclosure can only happen when someone's in default and it has not been cured. With reverse mortgages, a non-judicial foreclosure can happen. Now, you might be thinking, well, Amir, you just said reverse mortgages have to file a lawsuit. Yes, but reverse mortgages have to file a lawsuit when the borrower is still alive and has broken some promise under the terms of their reverse mortgage. And again, I'll get into what those promises are in a few slides. But if all the borrowers on a reverse mortgage have passed away, every one of the reverse mortgage contracts I've ever read, which is about 99% of the reverse mortgage contracts that are out there, say that the lender, the reverse mortgage lender, can foreclose without taking anybody to court, aka the non-judicial process. Now, as part of this, folks need to understand how much is part of the public record, how much is publicly accessible in the foreclosure process. When a bank files a lawsuit, those lawsuits are filed in publicly accessible court records. They are very rarely sealed. And what can happen is people who are looking to either be real estate investors or scam folks who are in desperate straits, dire straits, will have this record that they can compile and then contact those folks to try and take advantage of them or get a good deal. If a court order has been issued saying this house can now be foreclosed upon, or it's a non-judicial foreclosure sale, and the notice of foreclosure sale has been sent out and the foreclosure sale has been scheduled, those notices scheduling foreclosure auctions are part of public records as well. As I mentioned before, the first Tuesday of October is next Tuesday, in just a few days, October the 1st. Count back 22 days, you're looking at September the 10th. What you're then looking at, it is on September the 10th, if you were to go to, Harris County or Fort Bend County, the clerk's website or the clerk's office, they're going to have a record of everyone who has every notice that has been posted, scheduling people for the October 1st foreclosure sale. There are third-party websites out there that take that information, pull it from the clerk's website, put it in an index that can be searched by zip code, address, what have you. And there are reputable real estate investors out there that are looking to help people out, make a good deal. There's also a lot of scammers that will target you. Don't let yourself be a victim of a scam. If you're facing foreclosure and someone contacts you with a deal that sounds too good to be true, it probably is. Listed on the slide, the Federal Trade Commission, so this is a part of the US government, has an article about how to avoid foreclosure scams. If you believe you're being scammed or have been scammed, I urge you to reach out to a Department of Housing and Urban Development or HUD housing counselor, or Lone Star Legal Aid, or a private lawyer to see what your rights are and your options are. Now, earlier in the presentation, I mentioned loss mitigation. You see some citations to some laws that talk about loss mitigation. I want to jump back and get back to our vocabulary word. What does loss mitigation mean? Loss mitigation is the way to keep you from losing your house. And there is a legal process that controls that process to ensure that both sides are treated fairly and everybody knows what the rules are. So I'm going to read the top part of the slide out just to emphasize what loss mitigation is. Loss mitigation is the process of working with your loan servicer to avoid foreclosure after you've defaulted on your loan. So what does that mean? Something happened. I am now in default on my loan. I didn't pay the taxes, I didn't pay the insurance, or more than likely, I fell behind on payments. I don't want to lose my house. Now I'm working with the company that sends me statements that I pick, when I call customer service, they pick up. That's the loan servicer, to see what we can do to fix it so I can keep my house. Home retention is the goal of loss mitigation. It is literally, we want to find a way to change the terms of your mortgage or figure out a way for you to get caught up to keep your house. All loan servicers should offer some form of loss mitigation. Now, if you jump back to us talking about the two parties, the two players in mortgages, we're talking about the owners and investors and insurers. I'm going to refer to them as investors, and the servicers. Servicers have to follow the loss mitigation rules that investors set. And all investors set loss mitigation rules. If you have an FHA loan, a VA loan, a Fannie Mae loan, or a private loan, they're going to have some guidance on what loss mitigation they offer. Now, I will tell you, in my experience, FHA loans offer the most generous loss mitigation. VA loans offer pretty generous loss mitigation after. And then Fannie Mae and Freddie Mac follow very closely after that, in terms of they are backed by the federal government. The federal government created these programs to promote housing. So they want kind of ways for people to preserve their home. Outside of that, if it's a private mortgage, yeah, there might be loss mitigation guidelines. They're going to be looser. They're going to be more broad. They're going to be less generous. Now, all of that to say is all servicers, all loan investors are going to have loss mitigation. It's just how beneficial or how generous it will vary by who owns your loan, which is why we started with knowing who owns your loan. Is very, very important. As I just mentioned, the first bullet point, your loss mitigation options are going to vary based on the loan type. When we say loan type, is it a federally backed mortgage? Is it Fannie Mae? Is it FHA? Is it VA? Or is it a publicly traded, like it's part of the stock market mortgage? It's traded like a bond. There are going to be various options based on the loan type. Retention options. So when I talk about loan loss mitigation, we're talking about how to keep your house. Might be reinstatement. So you're behind a few months. You came into some money, you had friends or family, cobble the money together. You took out a second job and have been saving your money. Now you can pay to get you current. That's reinstatement. That's a very straightforward process. Most mortgage companies that I've dealt with have very clear guidelines for this. Forbearance. Forbearance is where we put a pause on most everything that's happening with the mortgage. So you don't have to make payments for 90 days. The mortgage company will not foreclose on you for 90 days. Both sides kind of cooling off period. Forbearance was very common in the first year or two of, the United States responding to the COVID-19 pandemic. Forbearances were uniformly offered for federally backed mortgages. Most of the private market followed along. And there are still forbearances still being offered on certain types of mortgages. We're going to talk about that in a few minutes. Set up a repayment plan, right? You don't need to change the terms of your mortgage. You just need to get caught up on 1, 2, 3, 4 months, and you can do that. A more permanent and very common type of loss mitigation or home retention is a loan modification. This is where literally we're going to get you basically a new loan. You might have had a 30-year loan at 6% interest, and you're 15 years into it. You fell behind, you're 10 months behind. We're going to get you a new 30-year loan. Now we're going to lower the interest rate down to 3%, but you're starting at you're starting at year 1. Now your payment's lower. Everything you're behind, the 10 months you were behind are rolled into this new loan. You have a clean start. That can be very, very useful for people who've gone through one of the 4 Ds. Again, remember death, disaster, disability, and divorce. A deferred balance or partial claim. So I referred to this earlier as a second lien. This is available on all FHA loans. It is, after that, it might be available on your type of loan. Really, you're going to want to sit down with somebody and review your documents. But on all FHA loans, this is available. And this is where you can take the amount that you're behind. Again, let's just use my 10-month example. 10 monthly payments, they're $1,000 a month, so you're behind $10,000. You work with your servicer, and they take that $10,000 and they put in what's called the second lien. You don't have to make any payments on it. At the end of your loan, or if you ever pay off the house, that's when that $10,000 comes due. So if you sell the house, the $10,000 will come out of the sales price. If you have a 30-year loan and you make it all the way to year 30, the very end, you're going to have to figure out how to pay off that $10,000. Most people take out, they refinance it, and then they'll pay it off that way. There are other options available for reverse mortgages. There would have been way too much on this slide to talk about those, but we will discuss those later on in the presentation. So I mentioned before, in response to COVID-19, I know it might seem like a long time ago. It was 4.5 years ago that everything started. There were a lot of what are called foreclosure moratoriums. It means the federal government said, you shall not foreclose on people if they have these types of loans. In addition to that, there were COVID-19 related forbearances. Most lenders have let their forbearances expire. That means they're no longer offering these. Now, the VA was offering forbearances through the end of May. They've set up some new programs since then. The FHA is still offering COVID-19 forbearances through October 30th of this year. So basically through the end of next month. So I want to provide an update on VA loans. I just mentioned that there was a brief moratorium in place through the end of May 2024. Now there is what's referred to as the VA servicing purchase, or the VASP program. What the goal of this is to lower the monthly payment and help people get current. This program did not exist until basically the early part of this year, and it's being rolled out. First, using the process of enrolling in it was voluntary for servicers. So banks did not have to offer this until after. They still don't have to offer it until October 1st, which is next week. There was voluntary enrollment in it basically from May until now. Now, if you have a VA loan and you're facing foreclosure now, what can you do? What are my action items? What can I do to keep my house? First thing is contact your loan servicer and say, I want to know more about the VASP program. They don't know what you're talking about. That does not mean it doesn't exist. There's some quality control issues with who you get on the phone whenever you call a loan servicer. Don't just take the fact that someone on the phone from PHH or NewRez or whoever, whatever your mortgage company is, does not know about the program. This is a relatively new program. It's less than a year old. The fact that somebody at your loan company, your servicer doesn't know about it, I would not take that as gospel. The next thing you can do is contact the VA Regional Loan Center. The number is 877-827-3702. Ask for them to help. Every VA loan has a kind of a designated person with the Veterans Administration to help make sure that the borrower is adequately taken care of. There's also information about this program on va.gov/housing-home-loans/trouble-making-payments. That's a whole lot. I think if you Google the VASP program, you will be taken to this exact same website. And just to pause real quick, I am now purple. I'm sorry, I can't do anything about that. That's just an issue with my camera. Bear with me 1 second. I'm going to try to fix it. All right. I'm not purple, but it's dark. I won't bore you with the details. But I see some questions popping up in the chat. I promised we will cover those in the Q&A at the end of today's presentation. So if you're not able to stick around, check out the recording. We will answer every question that's appropriate, in general in nature, at the end of today's presentation. As Samantha mentioned and as Nia mentioned, if you have specific questions to your specific situation, I'm not going to be able to answer those, not because I don't know, but because ethical duties of confidentiality mean I cannot talk about your specific legal issue in an open forum, even if you consent to it. And two, my employment contract with Lone Star Legal Aid and the grantors that fund us say we have to screen people for eligibility before we give out legal advice. So if you can't stick around to get your question answered, I will answer general questions at the end. If you have specific questions, I encourage you to contact Lone Star Legal Aid. Our contact information will be on the slides, which again is part of this recording. Now, I just went through some 2024 changes to VA loans. The FHA, not to be outdone because the federal government's trying to do right by its borrowers, also rolled out a new program in 2024 called the Payment Supplement Program. It's very complicated. Well, it's not complicated. It's a bit convoluted and hard to follow. You can read the bullet points on the slide, but the goal is for 3 years, the FHA Payment Supplement Program is trying to lower your monthly payment for up to 3 years. This program is still in the voluntary requirement or voluntary process, meaning it got rolled out earlier this year. As of May 1 of 2024, servicers were able to enroll people in the payment supplement program, but they weren't required to do so. The requirement to enroll people in an FHA payment supplement program goes into place January of 2025. This only applies to FHA loans. If you have an FHA loan, the way to know it is you can call your mortgage company and ask, or if you go look at your deed of trust, which you would have been given a copy of when you took out your mortgage, there will be something called an FHA number on the first page. If you don't have your deed of trust, you can contact the county clerk in whatever county you live in, Harris County, Fort Bend County, what have you. The deed of trust is recorded in the permanent deed records. Generally, you can review these online for free. If you can't, go down to your clerk's office and ask one of them to pull it for you. They're only going to charge you if you want a copy. Generally, they'll charge you, $16 for the first page, and then $4 for every page after that. Most deeds of trusts are about 20 pages long. So I encourage people, if you're going to request a hard copy of it, see if you can do it online. You can get it for free. If you can't do it online, maybe just get the first page. Just confirm it's got an FHA number. That's the whole point of getting your deed of trust. Now I want to talk about, okay, we've discussed all the things with mortgages, right? Here's the different types of mortgages. Here are the players. Here's what the foreclosure process looks like. Here are the loss mitigation or home retention options for different types of loans, VA loans, FHA loans, and what have you. But I have a unique situation. My mom took out a mortgage 20 years ago. It's a 30-year loan, and she recently passed away. Now, I've been staying with her, helping take care of her in her last years and months of life. Now, I'm having trouble paying the mortgage, and the mortgage company won't talk to me. What are my rights? What do I get to do? How can I keep this home in the family? It's the situation I just described is very common. For people in those situations, one, you're not the borrower. That's why the mortgage company is not talking to you, but there is a path forward. And the path forward is to get yourself confirmed as what's called a successor in interest. The successor in interest is kind of what the title assumes. You are succeeding your mom in that scenario with an interest in that property, and you can prove it. So most mortgage companies, to confirm you as a successor in interest, they want to know, one, like, did the borrower pass away? So a death certificate can be proof of that. And then two, they need proof of your relationship. So commonly what my law firm, what we do for folks is we'll help them prepare what's called an affidavit of heirship, which will detail all of the heirs of, using the same example, mom. And in there, your name is listed. You provide those two documents, turn it over to the mortgage company. I suggest mailing it, faxing it, emailing it. Do it one of two, or at least two of those ways, and keeping proof that you sent it. They have to respond within a certain period of time and demand they confirm you as the successor in interest. Once you're confirmed as the successor in interest, here's what will happen. The mortgage company will start, responding to you. They'll start talking to you. They'll start giving you information about the loan. They're going to put your name on the statements. Here's what's not going to happen. You are not responsible for paying the mortgage. Now, if no one pays the mortgage company will foreclose on you and use all those processes that I just described for the first hour of this presentation. But once you're named as the successor in interest, you really get a chance to make a choice. Do I want to keep the house? If I do, they're forced to talk to me. We can talk about the options. We can figure out how to get current. What documents, what more do I need to sign? What loss mitigation do I get to now engage in? Even though I'm not the borrower, they got to talk to me. If I want to become the borrower, they got to talk to me, and we can gather all the documents and get this mortgage payment lowered, get myself current. So as part of this process, I mentioned you could send the documents in, fax them, or email them. The most powerful and most effective way is to mail. I know it sounds, it's 2024. This sounds old fashioned, but this is referring to a law from the 1960s and 70s. Mail your lender or your servicer what's called a request for information or notice of error. Up until about 15 years ago, these are also referred to as qualified written request, or QWRs. We're talking about the exact same document. And it doesn't have to be fancy. If you are actually to Google notice of error, Consumer Financial Protection Bureau, which is a government agency, you will find a template letter online that you can fill in. You fill out your notice of error in which you say, here's who I am. Here's what I want. I want to be confirmed as the successor in interest. Enclosed with this letter is my mom's death certificate and an affidavit of heirship, or something else that proves that you are related to mom. Maybe there's a will. Even if you haven't taken it to probate court, if the will is from mom and lists you as a child or an heir, that is enough proof under Texas law to then use federal law to force the mortgage company to talk to you. Texas law and federal law work together in order to make sure that you can get confirmed as the successor in interest. And the reason why sending this by mail is so powerful is this federal law, the Real Estate Settlement Procedures Act, or RESPA, requires a lender or a servicer to respond within 30 business days of receiving the letter. So there's a couple of things I want to unpack there. They're required to respond within a certain time of receiving it. So I suggest if you send one of these, you send it by certified mail. So you get a little, and with a return receipt requested. So you get a little green card that has a signature that shows this person signed for it. I know what day they got it. Or this bank's representative signed for it. I know what day they got it. Then the 30 days are business days. So really that works out to be about 45 calendar days. Well, you get the green card, you know what day they got it, add 45 days. Now you know their deadline. That's so important because most of the time, most mortgage servicers will respond, but laws are only effective if they're followed or enforced. And so if you got to sue someone because they missed that deadline, they didn't respond, they didn't confirm you as the successor in interest, and now you're facing foreclosure, you got a pretty strong lawsuit against them. Now, obviously, consult with a lawyer, go through your personal situation to see if it's worthwhile suing or if you have a strong case. But it's important to gather that evidence. And I'm using that word important for an important reason. You can't just go into court without proving it. You need evidence to prove that the law was not followed. But doing all of these things can help protect you and protect your home. In addition to that Consumer Financial Protection Bureau resource that I described, you can actually check out Lone Star Legal Aid's website, lonestarlegal.org. And if you follow the arrows on the screen, you click on our resource library in the top right-hand corner. And then check the box on the right-hand side that's next to foreclosure. You will see the screen you'll see the portion of the website that's on your screen, which is get help if you can't pay your mortgage. And this is a tool that will guide you through the process of preparing that notice of error. So we've automated this process to help more people. We try to help as many people as possible. As Samantha mentioned, there's one legal aid lawyer for every 17,000 eligible people in the area of Texas that Lone Star Legal Aid serves. So there's going to be a lot of gaps. So we have this tool available on our website to automate this process. It's a relatively straightforward process, takes 10, 15 minutes online. And at the end, you get a letter that's personalized to your situation that's going to fit what you need, that you can print out, add the death certificate, the affidavit of heirship, and then be able to roll with to get yourself confirmed as the successor in interest. Now, we've been talking all this time about rights and responsibilities with mortgages. Let's jump to home equity loans. A lot of the same rights and responsibilities apply, but I want to get into some of the more of the specifics on why these types of loans are unique. So first off, let's break it down. Home equity loan. So let's talk about that first term. Let's do some vocabulary. What is home equity? Home equity is the value of your house above in excess of whatever you might owe on it. So on the screen, we have an example of a house that's worth $100,000 that has a $75,000 mortgage on it. That means you have $25,000 in equity. A home equity loan is where a bank says, we recognize the equity in your house. Your house is worth $100,000. You got a $75,000 loan. You got $25,000 in equity. Let us make you a loan so you can get access to that cash. Most of these have a fixed interest rate. Home equity loans traditionally, or most often, give you a lump sum. Home equity line of credit is you can draw from. We'll talk about that in a minute. But something to think about, something to keep in mind is this is not manna from heaven. A home equity loan is just like a regular mortgage with a few extra hoops to jump through. But if you don't pay back what you've borrowed, the bank, the lien holder, will be able to foreclose upon you. So a home equity line of credit, we have a lot of information here on the slide. What I want to emphasize is this is like using your house like a credit card for a period of time. You can take some money out, pay it down, take some more money out, pay it down. I can't tell you that home equity line of credits are bad for you. I've just never run into a situation where it's been good for one of my clients. I know I just said the exact same thing 2 different ways, but read between the lines, and everyone's situation is different. Home equity lines of credit exist for a reason. Somebody thinks they're good. I haven't seen it. But this allows you to, again, set up a basic line of credit. So let's just use the example of your house is worth $100,000. A lender's offered you an $80,000 line of credit against your house. There's going to be a certain period of time where you can make with monthly withdrawals or lump sum withdrawals from that $80,000 limit. Once you hit your limit, you're not going to be able to get any more money. You can pay it down and then get a little bit more. But once you end your draw period, you're going to be required to make minimum payments. So most HELOCs or home equity lines of credits that I've seen, I have seen have variable interest rates, which means your monthly payment can jump around. It's possible to get fixed interest rates on HELOCs. Again, everyone's financial situation is different. That's why we started the presentation by saying, make sure you understand your situation and consult with the relevant professionals before you make a decision like this. I don't personally see the benefit of working with a HELOC, but understand that going back with all the different, parts of them, if you don't repay it, if you fall behind, if you fall in default, the bank, the lien holder, the lender can foreclose upon you and take your home. So let's jump into reverse mortgages. Just a quick recap, a reverse mortgage is the reverse of a regular mortgage. That means you are taking out a loan, you're giving a bank a lien. Yes, those are the same as a purchase money mortgage, but you're not making monthly payments. In fact, the bank often gives you a lump sum on the front end. Now, reverse mortgages can be structured in a way to where you get monthly payments. Everybody's situation is different, but if you take the monthly payment option, you're going to pay a lot more in interest and get less money out. Now, this slide right here, in February 2023, AMOS did a presentation with Sherry Young from the Credit Coalition. She is a great person to know about reverse mortgages. I believe this presentation is saved on AMOS's website, either their Facebook page or YouTube page. If you're interested in learning more about reverse mortgages, I'm going to talk about them in detail, but Sherry's presentation was amazing. So I highly, highly recommend this AMOS presentation on reverse mortgages. So what is a reverse mortgage? Well, they're only available to folks who are 62 years or older, who own their home and live in it as their primary residence. Now, if you default on your loan and there's a foreclosure, this is not going to involve a credit hit. That's what it means by no personal responsibility or personal liability to repay the loan. The security for the loan is the house. That means they can take the house. Just because you don't have personal liability or responsibility does not mean the lender cannot take your house. It's a whole lot of negatives. They can still take your house if you don't pay. As I mentioned before, you don't have monthly payments, but not all that glitters is gold. The fine print that most reverse mortgage companies have gotten better about emphasizing. This is the fine print of every single one of those documents, every single one of these loans. You got to pay your taxes. You got to pay your insurance. And if you live somewhere with a homeowners association, you got to pay them too. So you don't have a monthly payment, but you do have bills. If you don't pay your taxes, the servicer, the reverse mortgage servicer, will foreclose on you. If you don't pay your insurance, they will foreclose on you. If you don't pay your HOA, they will foreclose on you. It's important to keep those things in mind. If you know someone struggling with a reverse mortgage, there are a lot of tools that can be used to save their home, to get them current. We're going to talk about a few today. Have him or her reach out to Lone Star Legal Aid. If we can't help them, we can generally connect them with someone who can. Another issue is that you can't allow your house to fall into disrepair with a reverse mortgage. So if your home was, you have a reverse mortgage and then Hurricane Beryl came through, or the windstorm in May, the derecho, and it ripped the roof off, your terms of your reverse mortgage, really any mortgage, a home equity loan, forward mortgage, or reverse mortgage, requires you to fix the roof. That's why you're required to have insurance. Now, insurance deductibles are outside, astronomical these days. That's a whole nother issue. But if you don't fix the house, that is a breach of your mortgage contract. And any one of those types of lenders, again, regular mortgage, home equity loan, reverse mortgage, they can foreclose on you at that point. The reason I mentioned earlier that there's two types of reverse mortgages, one where you can basically take a monthly payment where they will pay you over time, or you can take a lump sum where you get all the money on the front end. The reason I said the monthly payment is really not worth it is because if you look at the chart on the right-hand side of the screen, you're still getting charged interest. And over time, from month 0 until the end of the loan, most of it, whenever you pass away or over the time period that's set, that balance owed on the reverse mortgage is increasing. And as the balance on the loan increases, the balance available to pay you from the equity in your home decreases. So it's the exact opposite of a forward mortgage. As you pay over time, you owe less. Well, with a reverse mortgage, you don't pay anything. So you're in the best financial position at the very beginning. So if you're going to take out one of these loans, which again, the positives are few and far between, it's best to take your money on as a lump sum at the very beginning to avoid paying a bunch of penalty or a bunch of fees and interest. So a few more basics. The balance increases over time because the reverse mortgage servicers, they have what's called the mortgage insurance. It's different than homeowners insurance. I'll stop there. They charge interest and they charge fees. It grows higher and higher and higher. It might even grow higher than the value of the house. All of these types of loans are insured. 99% of them are insured by the federal government. So even if the value of that it goes above the house, the servicer is going to make money. As I mentioned a few times in the slides prior to this, the the balance of a reverse mortgage becomes due when you sell the house, or you've moved out and you've moved out for more than 12 months without permission. Maybe you've moved into a nursing home. That's very common. The last surviving borrower on the loan passes away. So you think of where you have a couple of spouses rather. They're both borrowers. One passes away before the other. When the last surviving spouse passes away, the reverse mortgage company can declare the balance due and foreclose on the house. Or what's the most common is the borrower defaults on the terms. So the borrower fails to pay taxes, doesn't pay insurance, doesn't pay the HOA, or doesn't fix the house. The lender declares the loan in default, files a lawsuit, goes through that process, and starts to schedule the property for a foreclosure auction. Now I'm going to pause here to grab a drink of water before we talk about heirs on reverse mortgages. So if you think about these types of loans or financial products or whatever you want to call them, you have to be 62 years or older. Folks who are reaching that point in their life generally have children or older friends, families, heirs, what have you, or other people in their lives that would be referred to as their heirs. If a 62-year-old takes out a reverse mortgage, lives in their house for 15 years, they're 77, he or she passes away. Well, there's a loan on the house, but what about the people who inherited the house? What are their rights? Well, heirs, if they want to keep the house, they have to pay off the reverse mortgage. The debt does not go away. The debt is tied to that lien. The lien is tied to the house. If the debt is not paid off, the lender will take the house. There's a process to go through for heirs to keep the house. There are some protections. Candidly, they're not always followed, and there's not enough lawyers or enforcement officers making sure servicers are following these on behalf of heirs. So if you know of anybody in this situation, I encourage you to reach out to, again, Lone Star Legal Aid or HUD counselors or any other lawyer or legal services agency in your area for help, making sure that your rights as an heir are being recognized. Now, I mentioned earlier, I gave you guys my perspective. There's very rare, if any, benefit to a reverse mortgage. That's not fair. As a lawyer, I only see problems, and I try to fix them for my clients. Now, on this slide, there are a few benefits, and I will begrudgingly share them with you. This is, again, you've gotten my opinion, but I do want to make sure that we share some objective facts. If someone is hitting age 62 and needs money to supplement retirement or money to help cover expenses that popped up that are unexpected, a reverse mortgage can be a very powerful way to tap into the equity you've built in your house. Maybe you've paid off your house at that point in your life, and all this value is stuck in the house. You can't turn it into cash without selling your house. You don't want to do that. The reverse mortgage fills that gap. So you can take out the reverse mortgage, and there's no restrictions on what you use the money for, right? The bank is, going to give you the money, and they're going to say, pay your taxes, pay your insurance, pay your HOA, and keep the house fixed. That's it. You can, folks might use this to send somebody to college, pay off a car, pay off an existing mortgage, right? You take out maybe you got 5 years left on your regular mortgage, you're retiring, you can't pay that monthly payment. Take out a reverse mortgage, pay off the remainder of the purchase money mortgage, Now you don't have a monthly payment, and your retirement's a little bit easier to afford on your fixed income if you've retired or drawing from your pension or your 401k. Other benefits are, this is a way to supplement your financial resources, right? You could take out the money from a reverse mortgage and just put it in your savings account and just draw from it every month to supplement your Social Security. You don't have to make monthly payments, so you have a little bit more control over your budget. You can live in your home without having to make monthly payments for the rest of your life, so long as you pay your taxes, insurance, and HOA bills. Reverse mortgages work best if you have no intention of leaving your house to heirs, right? It's your house, your kids are taken care of, or your heirs, if they're siblings or nieces or nephews or your children, are taken care of. Maybe they've all moved away and you don't want to leave them the house. You need the money to supplement your retirement so that you can live comfortably. This is a product that can help. Now, I'm not here to be a salesperson for the reverse mortgage. If you talk to me offline, 9 times out of 10, I will tell you it's a bad idea. 1 or 2 of my clients over 12 years, I've said, you know what, this fits. But these are the objective facts about how a reverse mortgage can benefit someone's financial situation. Let's talk about the risks. Not all properties and homeowners qualify. So if both spouses are not age 62, both spouses cannot be borrowers. Now, I've seen many reverse mortgage lenders work around this by having, a husband who's 60 deed his share of the property to his wife who's age 64, and then she's the only borrower. That can create some problems if the wife ever passes away. That's a little bit beyond the scope of what we're talking about right now, but we will discuss it in a few slides. Or you take out a reverse mortgage. You've used the money to pay off whatever. You don't have the money left over. You're now living on a fixed income. And then a hurricane comes through. And now you have a $10,000 bill to the insurance company to pay the deductible to fix your roof. And if you don't fix it, the reverse mortgage company will foreclose on you. The other thing is, most folks in Texas, anybody who owns their house in Texas, once you hit age 65, you can do what's called a tax deferral, which means pause paying your taxes. But you cannot do that if you have any type of loan on your home, especially a reverse mortgage. So let me just unpack this very briefly. I can get a reverse mortgage at age 62. 3 years later, when I hit age 65, maybe my county appraisal district tells me, hey, you're eligible for a tax deferral. You don't have to pay taxes. Or you heard through the grapevine, I don't have to pay taxes. Those two things do not compute. And if you don't pay your taxes, your reverse mortgage company will do a couple of things. First, they'll pay your taxes. Second, they'll say, pay us back. Third, they'll send you a bunch of letters saying that are very confusing. And fourth, they're going to file a lawsuit to foreclose on you. Not all that glitters is gold, and it's very important to understand your rights and read the fine print. I've already gone through all of these points at the very bottom of this slide. These are all the reasons why or ways that a reverse mortgage company can foreclose on you. A borrower can't leave the property. They can't leave the property to heirs unless someone pays off the loan. So we talked about this a few slides ago. The heir does not inherit a free house. If your children or your spouse wants to stay in the house, something's going to have to be done with the reverse mortgage. There's special protections for spouses who weren't borrowers, or as the next bullet point puts, non-borrowing spouses. We're going to talk about that. If you are put into a nursing home and you don't update the lender or get the lender's permission, you're there for 12, 16, 36 months. The reverse mortgage company will and can foreclose on you. These products charge interest. Even though you're not making monthly payments, they're going to charge interest against the balance. The balance is going to keep going. They also pay for what's called loan insurance or mortgage insurance premiums. Those are charged. They also charge servicing fees. They'll drive by your house. If you fall behind on something, they'll charge you $30 for an inspection. These things are added to the balance and can increase the amount that has to be paid off if you're ever in default or your heirs want to keep your house. And the loan balance, for all of these reasons, the loan balance can grow to exceed the value of your home. Now, again, you don't have personal responsibility to pay it back, but it makes it that much harder to keep the house if you or your heirs want to. So let's talk about reverse mortgage defaults and loss mitigation. So that's a bunch of fancy words. How do I keep my house from the bank if I have a reverse mortgage and something has happened? They've told me I've broken my promises. So what we're just to set the parameters here, what we're talking about are FHA, or Federal Housing Administration backed reverse mortgages, which again are like 99% of reverse mortgages. There's no one else is doing reverse mortgages except a very small part of the private reverse mortgage market. I've never seen one. I know they exist, but they're very, very rare. So all the rights we're talking about are for federally backed reverse mortgages, FHA backed reverse mortgages. So on the left-hand side of the screen under repayment plans, you'll see the terms HUD Mortgagee Letter 2015-11, HUD Mortgagee Letter 2022-23, HUD Handbook 4000.1. That is the source of the information I am going through on the slide. So if you want to verify what I'm talking about, or help yourself understand some nuance, or share this information with someone who's trying to help you, those are your sources. If you don't pay your taxes and insurance, the mortgage company, the servicer, will pay that so that they keep the house insured, and they keep the county, the school district from who is owed taxes from foreclosing on your house. That's a different presentation. We're actually doing a property tax foreclosure presentation in October. These are required to be paid. So if your mortgage servicer pays them, but what they're going to do is send you a letter saying, this is how much we paid for your taxes, pay us back. And they'll they might set a deadline for you to respond. They might set a deadline for you to request a payment plan. The payment plans that are available are on Mortgagee Letter 2015-11 and been supplemented by Mortgagee Letter 2022-23. These used to be, they used to have a lot of limitations, but basically a lot of those limitations have been raised. If someone he owes up to $5,000 in taxes and insurance or other things that a mortgage company has paid on your behalf for a reverse mortgage, you can still qualify for a repayment plan. These can be up to 60 months, 60 or 5 years. But one thing to keep in mind is that not everyone will qualify for one of these repayment plans. There's a lot of discretion. And these mortgage servicers, while they're not in the business of foreclosing, they read discretion pretty conservatively, because HUD rules dictate whether they're going to get paid in full or not. And if they don't follow HUD's rules for following repayment plans, or any of the rules for reverse mortgages, they might be looking at less than, getting paid less than the amount that's owed on the loan, which means they lose money. So there's what's referred to as an informal delay. That means if a borrower owes less than $5,000 or less and contacts the lender, so communication is key, says, I'm willing to repay, here's how I'm going to do it, they can delay starting the foreclosure process. It's important to communicate these things with your servicer, because they have to document it and send it off to HUD. Because these are FHA insured mortgages, HUD oversees FHA. Servicers have a financial interest in making sure they're dotting their I's and crossing their T's. If someone were to fall behind on taxes and insurance, and the servicer goes through the process of requesting what's called the due and payable notice, that's also referred to as acceleration for other types of loans. A borrower can get the loan reinstated per the terms of their deed of trust. That's a contract. All you have to do to reinstate is set up a payment plan, request a payment plan, repay the amount of money in full if you have friends, family, or charities that will give you the money. The restriction here, again, this is listed in the mortgagee letters in the HUD handbook, is it can only be done, this kind of reinstatement can only be done once every 2 years. Now, there is another process to avoid foreclosure if a borrower falls behind on taxes and insurance, and the youngest borrower that's still alive is 80 years old or older. they can qualify for what's called an at-risk extension. Now, there's a lot of information here on the slide. I'm just going to break it down for you guys. The at-risk extension is the borrower going to their doctor. So we're not talking about the mortgage company. We're talking about a doctor, a medical professional, PA, nurse practitioner, what have you. And the doctor providing a letter saying, if this person, the borrower, is forced to move from their home, their health will suffer. If you can get that documented, you provide a copy of that letter to the mortgage company and say, I am requesting an at-risk extension. I'm asking you to extend the deadlines, not foreclose on me, because my health will be at risk if you do. This is only available if you're 80 years old, if you get the documentation from your doctor, and you communicate with your mortgage servicer. It's all very important. The downside is this has to be done every single year. So if I help a client, or I have, if someone you know is 80 years old and they go through the 3 steps to get the at-risk extension in 2024, in September 2024, August, September 2025, they're going to have to do the exact same thing if they've not been able to get caught up on whatever put them at risk of foreclosure. And again, the risk of foreclosure are your house is in disrepair, you didn't pay your taxes, you didn't pay your insurance, you didn't pay your HOA. You can extend those deadlines by going through this process of getting the at-risk extension. Now, I mentioned earlier, there are some protections for what are called non-borrowing spouses. So I'm going to unpack that a little bit. I gave y'all a scenario where, husband and wife are married. The husband's 60, the wife is 64. They want a reverse mortgage for whatever reason. More often than not, the younger spouse then signs a deed putting the property in the older spouse's name. And now the older spouse is the only borrower. So now the younger spouse is a non-borrower. When the older spouse takes out a reverse mortgage and then passes away, you have a non-borrowing spouse who's at risk of being foreclosed on. Because remember, reverse mortgages can foreclose on you when all the borrowers, emphasis on borrowers, have passed away. When the older spouse borrower passes away, the servicer, the mortgage company, is required to send a letter saying, let us know if there's any non-borrowing spouses here. These are form letters, but they can be multiple pages long, and you can get buried in the legalese, especially if you're mourning the loss of a loved one. So it's important, if you know of anybody in this situation, have them read their mail or read it for them, and then reach out to an attorney to help them make sure they're not going to get the double whammy of facing the loss of a loved one and the loss of their home, because there's guaranteed legal protections. It's just you have to jump through the hoops to get them. So a non-borrowing spouse can get what's called a mortgagee optional election. There's a bunch of terms around this, but what I want you to understand is if I'm not a borrower on a reverse mortgage and my spouse was, and that spouse is dead, I can contact the reverse mortgage company, prove we were married, and ask the reverse mortgage company to ask HUD, so the federal government, to take back the loan. So this is the mortgagee, the mortgage company, giving it back to HUD. This is the option to elect for HUD to control the mortgage. And that will allow the non-borrowing spouse to stay there for the rest of their life. Now, the non-borrowing spouse will have to pay taxes, will have to pay insurance, will have to keep the house in good repair, and keep the HOA paid. You basically have to follow all the same terms. You just don't get any more money out of the reverse mortgage, but you get to keep your house for the rest of your life. So it's a very powerful tool for people who are, mourning the loss of a loved one and also had to, utilize a reverse mortgage at some point during their relationship. Now, the mortgagee optional election is a relatively recent protection. It was originated in 2014, rather. Actually, HUD had to be sued by a bunch of people representing homeowners to say, what are you doing? These widows or widowers are being foreclosed upon through no fault of their own. So there's a process. There's 2 different processes. If the reverse mortgage was from pre-August 4th, 2014, there's one set of process. If the reverse mortgage is more recent, from August 14th when it was created, August 4th, 2014, the the lender is supposed to have identified the spouse at the time the loan was taken out, and the MOE process is supposed to be automatic. So if you have a pre-August 2014 process, the spouse has to go through those steps to let the lender know, hey, I exist. Please do the MOE process and don't foreclose on me. If you're post 2014, the servicer is supposed to do this automatically. Your mileage may vary depending on who your servicers are. There's quality control issues that pop up all the time. If you, again, know anybody in this situation, I encourage you to have him or her reach out to Lone Star Legal Aid or another legal professional to see about making sure their rights are protected and they don't lose their home. So another option for these are actually options for heirs. So after the death of a borrower, so again, assume mom took out a reverse mortgage. She's got 2 kids. She passed away. One of the kids lived with her in her last years of her life. In that situation, the lender's not going to know that mom has passed away unless someone updates them. So one of the heirs, one of the children, reaches out and says, I want to know what's going on with the reverse mortgage. We'd like to know about paying it. By law, you're entitled to 2 separate 90-day periods to do one of the following. Sign the deed over to the lender so there's not a foreclosure sale. There's some advantages to that. It's referred to as a graceful exit. Or sell the house for at least 95% of the appraised value. Basically, you're getting rid of the house, you're selling it. You're not going to get any, you're more than likely not going to get any money out of it. But again, this is another form of a graceful exit. What's more common when heirs are able to be proactive with the servicer is to pay off the loan. So you refinance it, right? We know the balance of the loan is this number. We went to the bank down the street. We're going to pay off the reverse mortgage so we can keep mom's house in the family. That takes time, which is why you can request these 2 separate 90-day periods after the death of the borrower. Now, you can ask for extensions, but there's no legal right to it. More often than not, it's permissive. What I will emphasize is that you need to think of the practical steps here. In the situation that I just described, the children are going to know that their mom passed away. The bank is not. And it's incumbent on the children to, 1, know that their mom took a reverse mortgage out, 2, contact the bank and then line up what it is that they want to do with the house. If you want to sell it, you want to transfer title, there's your graceful exit. If you want to keep it, before you contact the bank, don't take too long to contact the bank, but before you do, start looking at other types of loans to pay off the reverse mortgage, because that's the only way you're going to be able to keep the property in the family. Now, there's some discussion on this slide about as part of those graceful exits, people can get up to $7,500 to basically turn over the keys, get some cash to move out. These are options for folks who, again, are not looking to hold on to the house, who need to move on to another housing option. Now, all of the information that I just described is available on a very useful 1-page flyer. You can find this by searching for the Federal Housing Administration, or FHA, documents. We have this listed on the slide. Sorry, guys. My headset was coming out. And here we go. We have this listed on the slide, but if you're interested, I encourage you to check this out, because it's going to summarize everything that I just went through on the prior few slides. Now, a few additional comments with mortgages. I know we're about 17 minutes before the end, but we're going to finish up mortgages. Then we're going to talk about non-traditional forms of financing. You're going to hear from somebody else besides me. If you have an issue with your mortgage company, you have rights and you have the way to assert them yourselves. I highly recommend that anybody who's got an issue with their mortgage company to file an online complaint with the Consumer Financial Protection Bureau. If you were to just Google CFPB, Consumer Financial Protection Bureau, complaint, you will find this website that's listed on the slide. You can also submit a complaint by phone. If you have an FHA loan, so a reverse mortgage or an FHA purchase money mortgage, you can file a complaint by contacting the National Servicing Center. Their website is listed here and their phone number is listed here as well. If you don't qualify for loss mitigation, so we talked about how ways to keep your house. There are some other options to save your home. You can refinance the mortgage, right? Just because you have one type of mortgage on your house doesn't mean you can't pay it off with a new type of mortgage. You might be able to file for Chapter 13 bankruptcy to repay the mortgage in a 5-year bankruptcy plan. It might be best for you to sell the property if there's just no way of holding on to it, because that will allow you to capture the equity, aka sell it for more than it's owed, so you can get the difference and use that money to start your life off in a new form of housing if you're renting or you find a new house that you can afford. Other things is that you can get the lender's permission to sell it for less than it's owed. This is referred to as a short sale. This is a different form of graceful exit. This is involving you communicating with the servicer. One thing to know is that when you're no longer the owner of your home, if it's been foreclosed upon, the new buyer cannot just tell you to get out, or it cannot just say you have to get out now. They have to go through a process to legally evict you. And that process starts with a notice that says you now have 3 days to get out. After that, they have to take you to court and sue you for an eviction, to have a constable put you out, but they can't just come by and say, get out now. That's referred to as a self-help eviction, and those are illegal in Texas. There are resources available. So if you check out HUD.gov, HUD.gov, look for HUD housing counselors. These are free people who will talk to you about budgeting and your options available under federal law for the type of mortgage you have. They're not just for FHA loans. They cover all types of loans. They can help you make better informed decisions on how to keep your house or if it's feasible. And they can also funnel you to a lawyer if need be. They can direct you to Lone Star Legal Aid or private lawyers or legal aid in your area, you're part of the state, to help you evaluate your legal options. But there's a practical side. Do you have the budget? HUD housing counselors can make it work. Can help you understand that. And then understanding the legal side, you're really going to want to reach out to a legal professional at that point. And HUD counselors can help connect you with those folks as well. All right, I'm going to mute myself and turn it right back on over to Sam for her to talk about contracts for deeds.
Okay, everybody. So let's talk about contract for deeds and what are contract for deeds, or also known as executory contracts. Let me make sure I can control my slides. Okay, so executory contracts are a long-term agreement to buy a property. They are different from traditional owner financing mortgages, where the seller retains the title to the property and the buyer does not receive a deed to the property at the time. Sometimes these can also be known as for sale by owner homes, where you're dealing with the homeowner and not a traditional mortgage company. Or it could be a mortgage company, but it's not one of the big ones, the privately owned, and it's just developers selling you homes where you pay the developer or the person who owns it. The buyer does pay a down payment followed by monthly or periodic payments over time with a minimum of 180 days per contract. After you issue your final payment, then the seller will transfer the deed to you. So who buys property using executory contracts? Buyers who have low credit scores, who've had a recent bankruptcy, or who cannot get financing from a traditional lender. There are buyers who have little or sporadic employment history, or who have a high personal debt to income ratio. Buyers can also be people who have changed their employment situation. I know that traditional mortgages often want you to have stable employment for a certain period of time, but executory contracts can navigate around that. And then there are also buyers who can't afford a large down payment or typical mortgage fees, such as closing costs, and who have insufficient collateral for a mortgage loan. So what is important about these contracts? Well, for starters, they're potentially predatory. So let's keep that in mind. And because of that, Texas law has now added strict consumer protection laws. Some Texas legislature has found that executory contracts for the sale of residential property have long been disfavored because they encumber title without transferring title. They cannot be sold in the real estate market, and they cannot be used to borrow money to make improvements, and are potentially abusive transactions under which legal title to homestead property may be withheld until many years after the buyer has built a home and made other expensive improvements. Some Texas property code referring to executory contracts would be in Chapter 5, Subchapter D. This statute applies to any transaction involving an executory contract for the conveyance of real property to be used as residence by the purchaser or purchaser's family member, where the contract is to be completed more than 180 days from execution. This includes residential lease agreements with purchase option, such as lease to own contracts, but some other consumer protections don't apply. This does not cover contracts with governmental entities or between family members. So I can't sell my sister a home that I own under this property code. So, it also has to be a parcel of land measuring 1 acre or less and is assumed to be residential. It also provides statutory obligations, remedies, and statutory damages for violations. So if they don't adhere to this property code, there could be statutory damages for violations for not adhering to them. There are many risks to buyers who use executory contracts, and we'll cover those right now. So you don't become the legal owner until all payments are completed. You do own the land under contract, but you won't obtain the deed until your final, like I said, your final payment is made. So there's always a chance that the seller could come back and say, hey, just like a mortgage company, but they could come back and say, hey, we're taking the home back from you and we're foreclosing. There are now options for a buyer to get title during the term of the contract, but you have to know about and exercise your rights. And that's why we're here. You do have limited control over the property while under contract, especially if the contract is not recorded. We've seen here at Lone Star Legal Aid some executory contract issues where the seller didn't record the contract in the property records. And so, the buyer has issues with trying to work out their property issues, but they can't because there's no record. And if you find yourself in an instance where you're in an executory contract situation, if the seller does not record the contract within the property records, you can record that contract on your home if it is notarized. So when you're signing your contract, if there's a notary there, you can take that contract and submit it to the property records, the county records, only if it's notarized. If it is not notarized, you can use a signed notarized affidavit of facts, add that to the contract, and then you record it with the county. You can find more information about that at Texas Property Code section 12.0011B2. So remember, if your contract is notarized when you initially sign it and your seller doesn't record it with the county, you can record that on your own. You don't need their permission. If it is not notarized, then there's a signed notarized affidavit of facts that you can add to the contract and then record it to secure your home. Other risks includes potentially losing the property and all money paid toward it if you default. The seller can cancel the contract and retake the property, keep all the payments you've made up to date, and benefit from any improvements that you have made. They can also may not have cleared the title even though they are supposed to. So traditional mortgage companies, they do run a title check and make sure that the person that is selling the home does own the home legally. With executory contracts, that's not always the case. You do risk somebody saying, hey, I own this home, I'm going to sell it to you with cash payments, or, just me and you, we don't have to get a loan. And then you come to find out that they don't even own the home. So now you're stuck, you're out all of that money and you're out of a home. The seller may also continue to encumber the property with mortgages and liens, even though they aren't supposed to. So what that means is that if they own the home and they're selling it to you, they can go out and get a second mortgage on that loan, and not tell you about it. Which means, and then let's say they stop paying their mortgage, and then you start getting letters in the mail that says, hey, we're foreclosing on you because you haven't been paying your mortgage. And then you're like, what do you mean? This isn't even addressed to me. It's addressed to the seller. But now you're out of money and a home because they did that behind your back. They're not supposed to, but we'll see. The seller may try to evict the buyer, which is a quicker process rather than foreclose, which is a longer process. So you have some protections, and so you have a right to convert your contract, which I discussed. Like I said, they're required to record the contract. They often do not. You have the right to convert the contract to a recorded legal title at any time without penalty or charges. So let's say you buy the house 2 years ago and you're still in this contract, and then you find out today after our presentation, you go and you look in the county records and you don't see your title there. You can take your contract that's notarized and file it with the county records. There's no penalty or charges. The seller has no choice in the matter so long as the buyer tenders the balance owed under the contract. This is true whether or not it was recorded, the contract was recorded. You have a right to request the balance and the trustee. The owner is supposed to send you a balance and an annual statement every year at the beginning of the year, telling you how much you've paid thus far and what your balance owed is. You can demand to know the amount owed under the contract, and if applicable, the name and address of the seller's desired foreclosure trustee. If the seller fails to respond within 10 days, you can determine the amount owed, and if applicable, select a trustee. You have 20 days to contest the amount determined and must send a written objection to the buyer. Your objection must be based on written records maintained and regularly updated by the seller. So it is very important for you to obtain that annual statement every year. If they don't send it to you, request it, but they are required to send it to you every year. Excuse me. You have a right to deduct. You may offset amounts it owes the seller against amounts for which the seller is liable as a result of its violations. So if the seller is not maintaining their legal obligations, you can ask, excuse me, for that to be looked at. And if it's found that they're not upholding their legal obligations, then you can be eligible for monetary damages. You do not need to sue the seller in order to offset. You do have a right to cancel your contract. If for any reason within the first 14 days of the contract, you can cancel it by giving a written statutory notice. So, and how to record your contract for deed. If the seller doesn't record the contract in the county deeds records, the buyer can record it themselves. And as we mentioned, it must be notarized, and a notarized original copy or a certified copy attached to an affidavit. You can file it in person at the county clerk's office or by mail. And why do we keep bringing up that it needs to be recorded? Because like I mentioned, oftentimes we find that the seller does not record it and you're not protected as you would be if it was recorded. So we like to stress that you ensure that your contract is recorded to give you those rights. So if you have a copy of the contract, you can still record it, but you will need to include a notarized affidavit concerning executory contracts for the conveyance of real property with the original executory contract. In this affidavit that has to be notarized, you must include your name, the state that the attached affidavit is true and correct copy, and you're recording it under Chapter 12 of the Texas Property Code. You must also state that it is an executory contract for the conveyance of real property under Chapter 5 of the Texas Property Code. You must include the property address, the legal description of the property, which you can find online also in your county appraisal district's website, your county property records and such, or even on your contract. You must also include the names of who signed it, which include the buyer and the seller, and the date it was signed. And that the contract was not already recorded, but that you're recording it now in accordance with Chapter 5 of the Texas Property Code. And if the property is your homestead, state that as well. So all of that information needs to be in a notarized affidavit. So, and then you take that notarized affidavit, you attach it to your original contract, and then you submit it. And again, I know we stress it, but this is for your protection. So what happens if you default on your contract terms? First, the seller must give you a written notice of default by certified or registered mail. So they have to have a record that it was sent to you with certain statutory language and give you 30 to 60 days to bring your account current. If you have paid less than 40% of the purchase price or less than the equivalent of 48 payments, a 30-day cure period is required, which means you'll only get 30 days, a minimum of 30 days to bring it current. If the contract is not recorded, then the seller can rescind the contract and evict after 30 days. So this is why it's very important for you to record the original contract that's notarized or the original contract with an affidavit, a notarized affidavit. If you have paid 40% or more of the purchase price or the equivalent of 48 payments or have a recorded contract, a 60-day cure period is required. So if your contractor is recorded or paid more than 40%, you will have 60 days to bring your account current. If you fail to bring your account current, then the seller may sell your interest in the property at a foreclosure sale. Following foreclosure, the purchaser may file to evict the buyer. So this kind of follows a traditional mortgage foreclosure process. If you have paid more than 40% or more towards your contract. And I guess that's it. So I guess what I want to take away from executory contracts is to make sure you have a clear title and you record your contract. And I guess we have a ton of questions, Amir.
Yes, we do. I think I've answered most of them in the chat. I asked for clarification when there were and I just couldn't figure out what the question was. But yeah, I'm happy to answer any others we are happy to answer any others that might have popped up since.
Can you actually go over some of those questions? Because for the folks that are online via Facebook or YouTube, they can't see the chat. And there may be a couple of those questions in there that could be relevant to what somebody else may be going through as well. And then I can't see, I got kicked out, so I can't even see the question. I see your responses, but I can't even see the questions anymore because it took it away.
Sure. So I'll read the question and then I'll read the response that either Sam or I gave. So the first question is from Leticia. Under what conditions will the loan owner change servicers of your loan? Are there circumstances that increase the possibility of that happening? That's the question. So the response was, we often see servicers change when there's been a default on the mortgage. In other words, servicers will change when it looks like a foreclosure is about to happen. That said, there's no requirement that this process follow through. Investors can change, ownership of the loan can change, and the investor just might want to work with a different servicer. The investor relationship with the server is a contract, so there might be terms in that contract that allow the investor to just change the servicer like they change their shirt every day. Or the servicer could be doing a bad job, and so the investor wants to change. So that's the answer to that one. I saw another question.
Can heirs be provided upon, no wait, it was the one about Todd's. Can you be proactive and get an affidavit of heirship prior to death so everything is in place upon death?
Let me get down there. I think I skipped over that one.
Well,
If you see my response, go ahead and
Yes.
read it.
Yeah.
So the short answer is no, but proactive estate planning can be done. We do recommend that you use a transfer on death deed so they can designate who will inherit a home. For those of you who don't know what a transfer on death deed, we call it a TOD. It allows the heirs to get title to the home without going to probate. So the person who owns a home can use a transfer on death deed to say, I want my child, Sonny Joe, to inherit the home after I pass away. Once they file that into the county records, it's a done deal. Sonny Joe will inherit the home when I pass away. You can also get
their ownership interest, because they may not own the house outright. It could be man and wife, or, you know,
well, yeah, you would.
what interest is.
Yes. Well, in my example, it was just me and I'm a single mom.
Gotcha.
I'm not a single mom, but still. You can also, a will is another way of proactive estate planning. Amir recommends a will for all of your other stuff and a Todd for your home.
Thanks, Sam. And I saw that Dr. Tatum has her hand raised. There were a number of questions from her that we're asking for some clarification from. So go ahead.
Hello, hello. You need to unmute yourself, Dr. Tatum.
Hey guys.
How are you?
Yes, I am doing good. So, we're recording this online too. So I want to say shout out to all the nonprofits. If you are looking at this and your clients, get on everybody's email list. You cannot say we don't have resources, and we're doing this every single month. So again, I want to make sure clarity. We have a lot of clients out there, and a lot of times we always say there's no resources. We don't know anything. But look, as busy as I am, I always try to chime in on what you guys are doing.
Indeed.
Okay. So as a nonprofit, and like I said, I'm boots on the ground. I try to ask questions that people are coming to me. I am not a lawyer, but these are some of the things that I feel like it's been on the news. People are losing their house. As you guys know, we saved a lot of people's houses even before the pandemic on even making sure their paperwork is good, and people living in their mom and dad's home and not doing the paperwork. So this program does work. So one of the things that people are asking me is, I think he said one of them was, when they file on escrow and you originally bought your house and it wasn't escrow, no one's talking about the laws that, for example, I'm also a real estate agent, so I do understand that rebuild of the house. So here you have a homeowner's insurance. You can get it on your own, and before you used to fax it into the mortgage company, they left it alone. So it seems like after the pandemic, they are raising these homeowners insurance and not returning the homeowners. For example, the homeowner can get $1,200 to $1,700 on their property. They only owe $104,000. You can rebuild a house for $150,000. Mortgage company gets it for $278,000, which ups to monthly maybe $1,000 up to $2,000. Where is if they foreclose on that person, where is the protection to tell the judge, to tell anybody, the non-judicial, hey, they're wrong, they haven't done it? And the other one is flood insurance. If you're not in a flood district, the insurance company or the mortgage company should not be making you pay it. It's kind of your choice. Why are they forcing some people to do it? Where's the protection of the consumer to say, hey, I don't owe flood insurance. I'm not in a flood zone. They owe me a refund. And why are they so high on homeowners? And now they did foreclosure on it.
Oh, can I answer that part, or you can do the legal side? But I do the I have a certification for the homeownership counseling or the housing counseling and the home buyer education, and I'm a realtor as well. Of course, it's up to the consumer to actually get their own homeowners insurance. They should never rely on the mortgage company to get insurance for them, which is why it costs an astronomical amount of money for them to actually carry the home. And it's a basic policy that only covers the structure. Now, as far as what a rebuild would actually cost, that really just kind of depends on the construction company that they're going through or what have you. But supply costs are extremely expensive, and they continue to go up after every single disaster. So you may have a house that's only worth $106,000, $110,000, $140,000, but to actually rebuild it from the ground could cost you $200,000, $220,000 to rebuild. So the mortgage company wants to make sure that if something happens to this house, that we've got enough insurance coverage basically to cover the cost to rebuild from the ground up, period. They only want to protect their interests. So in that regards, I would definitely tell a homeowner, get your own homeowner's insurance. Do not go through a mortgage company to provide you with homeowner's insurance coverage, because you will not, it is not for your best interest. It does
And
not.
that's what I'm saying, Miss Nina. When you get it, for example, and I'm gonna give you I'm just talking about Texas. This client used Texas Assistant Program, and they were paying people's escrows and updating them all. So what they happened was that they've been in our house for 26 years, and their normal homeowners is $1,700. The mortgage company did $3,100. They got their own. And they sent it in, and the mortgage company's like, no, even though you owe 104, if something happens to the house of my interest, that means you should be paying for. That's why I'm saying we need to explain it to the outreach. If I only owe 104,000 and you got 278, do we even know the statistics of any mortgage company that if it did something happen, they went back and rebuild it? I don't know any statistics. They're going to get their 104,000 and move away and actually made a profit of another 100,000. Do we even have any numbers out there?
Generally, that's not how the homeowner's insurance works. They don't, it's basically once a person pays off their mortgage, the insurance, they can do whatever they want with the rest of the money for the value of the difference of the policy. So if the mortgage is paid off, the difference should then go to the consumer. It's not that the mortgage company gets the difference plus the cost of the house.
Well, okay, that's wonderful. But what I'm saying is if the homeowner got their own homeowner's insurance, and as you just said, they can get their own, but the mortgage company is refusing to accept theirs because they want it on the higher amount. And all they did was the structure, and the appraisal district appraised their home at 150,000. They want it for 278. And if the homeowner does not pay the difference, they're telling the judge that we're foreclosed on because they didn't pay the whole thing. Where's the protection at?
Because that's what I'm saying. So the cost to actually rebuild the house, they may not have accepted it because the coverage that the client may have had may not have been enough to actually rebuild the house.
Yeah. I'm just thinking some people are losing their home. I don't, on that, because even as a realtor and I build houses, I can build a house for 150,000. That's almost like an opinion of things. And it's so dangerous when they're sending it to courts. I just think it's dangerous.
That's why it's really important for consumers to do their own due diligence, to do their own research, and make sure that they are comparing apples to oranges. What you may be charging me over here may not be what this person is charging me over here. What I may think I'm getting coverage over here, I'm not actually getting coverage. So when you're out there actually doing the homework, you need to make sure you're comparing apples to apples.
And I agree with you. I just don't know if there's any protection for them. Who do they go to where they're arguing back and forth going, I have enough coverage, but you want me to pay another extra 1,500. And if I don't have that 1,500, people are actually losing their homes off of escrow. Even some states are saying we need to stop this escrow versus housing. So I didn't know the legal term of where's the argument at and how do you protect somebody? So I'll let that go.
For the insurance, I'd also say contact the Texas Department of Insurance and ask them, what are the rights for insurance coverage for consumers. But there is a Texas Department of Insurance.
Is that the abundance? I don't know if I'm saying it right. The abundance. Can you see? I'll write that down. Is it Texas? That's something I really can give her.
Let me look it up, and I'll put it in the chat.
Thank you.
But go ahead with the next question, you guys. Sorry.
It's quite all right. I mean, these are all very fair questions, and just to put a pin in it, I got a elderly couple that I've been helping for the past 2.5 years with a variety of issues. We got their mortgage caught up using the Texas Homeowners Assistance Fund that I think Dr. Tatum mentioned, and their homeowners insurance premium increased by 25%, and they're in their 70s and 80s. They can't afford that, and now they're 10 months behind on their mortgage and they can't get caught up. Now, some of the things that we have done are everything that Nia mentioned. We've shopped around for insurance. They got force-placed insurance from the mortgage company. It was a lot higher. We shopped around, we found them cheaper policy. Problem was, by the time they informed us, Lone Star Legal Aid, of the process, they were already several months behind, and the Texas Homeowners Assistance Fund had run out of money. So they're facing the loss of their home. I will say, shopping around is the best thing you can do. But that being said, you know, in Texas, insurance premiums over the last 5 years have increased 54% on average.
As
And so, you know, just personally, like I know my insurance tried to increase $900 2 years ago. I shopped around and limited the increase to $600, right? I didn't have any dang claims. It's just insurance companies are passing the risk back on to consumers. One last thing on this point is
a lot of them are pulling out too. They're pulling out.
yeah, yeah. One last thing on this point is I did put some details on your question here, Dr. Tatum, in the chat. If a borrower has an escrow complaint, and I'm purple again, I hope you guys don't know. It's my computer camera. If a borrower has an escrow complaint, and when an escrow complaint is the mortgage company said or did something with my taxes, the mortgage company said or did something with my insurance, that's an escrow complaint. Escrow is somewhere between 1/3 to 1/2 of most people's mortgage payments. If you have a problem with your mortgage company on that, you can do 3 things. One of 3 things or all 3 things. You can file a complaint with the Consumer Financial Protection Bureau. I mentioned this during the presentation, but I want to emphasize it's very powerful. First up, just Google it. CFPB complaint. It's online. You can get done with it in about 10-15 minutes. You have the ability to upload documents, really document your complaint. The CFPB will contact the mortgage company, get a response when you might be dealing with a mortgage company that's not responsive, and then provide that information to you. So you're empowered to make a more informed decision. If you're in Texas, you can file a complaint with the Texas Department of Mortgage Savings and Loan. They have a very similar process. They rope in the Texas Attorney General if they see one mortgage company starting to do the same bad thing to a bunch of people. The CFPB and the Texas agency I just mentioned are not your lawyer, but they exist to attack systemic issues. So if they see one company doing the same thing to hundreds, if not thousands of people, they will do something. Those are the first steps. It's important to kind of be that canary in the coal mine by filing these complaints. And I want to emphasize they can be done online in 10 to 15 minutes. So it's not a huge time suck. And then you can take that same information that you put in your complaint form and then put it in that legal demand letter that I mentioned earlier called a notice of error. And you can use Lone Star Legal Aid's website by following the steps that we detailed in the slides, by going to our website, looking at the resource page, checking the box for foreclosure, and then going through our tool that will literally build this letter for you and say, you send that letter to your mortgage company. In your letter, you say, I dispute what you're saying about my insurance. You say I need, $300,000 of coverage, but my house is appraised at 150. Here's the insurance policy that covers me 150. Please apply it to my mortgage. Or I dispute what you did with my property taxes. They're too high. You're trying to collect too much in taxes. We do that often for the homeowners we're able to help. And that can be very powerful because it lowers that 1/3 to 1/2 escrow portion of your mortgage payment. So I just wanted to emphasize and read those answers out for those of y'all who end up watching this on recording.
Absolutely powerful. Those are the calls that I'm getting in. It's all about the escrow. So I'm going to send them to your page, and also everything that you guys put in the chat. That's the questions I'm getting that, hey, I'm updated, especially with that Texas assistant program. Everybody was updated. And I was one of the first people that saw that and was giving it out to clients. So that is very powerful. And I'm going to send that information out. I don't know if you guys can email or put that on there, but I see Naya just put some information in there, but that's a lot of questions that I'm getting right now on what can I do? And the other one was, what's my protection of flood insurance? Yes, everybody should have it, but they applied it and keep charging them, and you're not in the floodplain. So FEMA, if you go to their toolkit, it shows their house is not in a floodplain. If you go to Texas flood things, they're not in a floodplain. Why is it so difficult for the mortgage company just to look that up? And when they do these complaints, is it going to affect them negotiating? They're scared of that. I do a complaint and then I'm negotiating with them. Will they take it out on me, or do they just take the chance?
We submit complaints for probably half of the clients that we serve, and there's no negative blowback. What it ends up doing for us is I'll use an analogy. The mortgage company, I'm knocking on the door for the mortgage company. Ain't nobody knocking the door. So when I file the complaint, that's me going and getting mom And you know what I'm saying? Like, they're not listening to me. They're going to listen to the regulator, who then can call and say, why aren't you doing these sorts of things? I know I've kind of mixed metaphors there, but it has never blown back or negatively impacted any one of our clients. Like, obviously, I can't tell you what's going to happen for every single person, but what it's helped us do is break through impasses when we're not getting information or someone's just ignoring us. And it informs regulators, like, these bad companies are doing bad things. Think about it like this. Sam and I described all of the laws that are in place to protect people. Speed limits are like the law too. People speed all the time, but it's only a problem when you get caught by a cop. There are not enough consumer advocates, aka cops, to protect every single person. There's just not. So by filing these complaints, it's like your local neighborhood saying, we need these police officers on this street because there's kids walking up and down the street and people are speeding. Does that make sense? So I hope that helps. It's a very frustrating position to be in, you know, as Sam mentioned, and I'm going to just drive it point. I think we're all talking about the same thing: lack of resources to help solve this problem, right? You try to educate people as much as possible, but, you know, there's one legal aid lawyer for every 17,000 people. I can handle about 60 clients in a year. I can't handle 17,000. And that's just, you know, the finger trying to solve put the finger in the dike. And I'm purple again. Sorry.
I think you guys, y'all did an excellent job. I mean, I think you helped one of our clients right away, guys. Just I'm saying, if it was filed on the 11th, you don't have to move out. You make sure you talk to somebody, because her thing was filed on the 11th and she's thinking her house is being sold on the 2nd. So we see the TV, we don't know, and they don't know your services. But I honestly, I think every last one of you guys, are all the work that you guys do. I appreciate you. Bye.
Thank you very much. All right. The links for each of the departments and everything that you just mentioned are in the chat. And hopefully when I go back to get the recording, it'll show me the entire chat that everybody could see all the links that were put in there. But I will also make sure that they are included in the link of this recording of this session for people to go back and ask to. I know that there were a couple of other questions that you had already addressed that were in there that we did not ask, but I believe that you covered everything that was emailed to me prior to, as well as what I see like that was on Facebook as well. So we are like 20 minutes over our time limit. I do want to be mindful and respectful of you guys' time. We definitely appreciate you guys for taking this time out this afternoon to provide this information to the public. Again, we do these foreclosure presentations the 4th Thursday of each month. Next month, we will be talking about the property tax foreclosure process and what prevention measures can be done to keep that from happening. I'm going to try to get Jamie from the tax assessor collector's office to be present as well, to kind of address any questions that she may have, that people may have from the tax office. So I'm going to see if she's available to be here as well for that. But definitely join us if you guys have more questions, if you need more information, if you want to invite people to come and sit around the TV like you're watching a movie to watch the presentation, have them come in, and, you know, because we tried that at one point, you know, going out to different little areas and seeing how we can get people set up, because there's a lot of consumers that still don't have computers, and, you know, that technological divide is still there for a lot of people, and they don't necessarily know how to get on Zoom or, you know, look things up on YouTube or whatever. So we, again, want to try to do whatever efforts that we can to get as much information out to the public as we possibly can. And we thank our community leaders, like Dr. Tatum, like Pastor Deb, who was on before, Miss Lydia, Miss Letitia, and the other person that is also joining us for actually getting this information out for us as well. So thank y'all very much. Cecile, is there any, next week, what do we got next week? Cecile, anything you want to add before I talk about what we got next week?
Let me pull it up, because every day is sometimes a blur to me. So I know we have something going up early in the week.
Yep, we have
Tuesday, October 1st, summation of probate matters. Then we also have on Wednesday, the 2nd, a 4 o'clock savings, establishing a fund for rainy days. And then Thursday, we have wills and advanced legal planning, why you need it.
Mhm.
It's a week packed of really important and useful information.
Absolutely, absolutely. I will include the October schedule along with this recording as well, so everybody can kind of go ahead and get things posted on their calendar for what they would like to attend for next month. Thank you very much, Dr. Tatum, our amazing people. It was not easy, but you will get that. We thank y'all again for participating, for tuning in, for volunteering your time and your expertise to provide to the community. Thank you, Amir. Thank you, Samantha. We appreciate you guys. We will see you all next time. You all have a wonderful remainder of your afternoon. Take care of yourselves and stay safe.